So for our first speaker for this afternoon session is our most beloved and trusted COL, Chief Technical Analyst.
Yes.
So you all know him? Ayun na siya?
Yes.
Okay, so ladies and gentlemen, a warm Trader Summit welcome to
Mr.
Juanis Barredo.
All right, good afternoon to everybody. So was it a hard choice for you to pick room 1 or room 2? No. Thank you. Well, it comes around to be able to prepare ourselves in our ability to generate action into the market, that the preparation of our trading mind becomes very essential. Earlier, you saw some of the speakers talk about how they attempt to be able to look at the market. You could see some people by themselves, it felt like an arm and a leg to try to explain because trading is actually quite difficult. Now, practice is very important over here, but you can only practice the particular skills that you're learning. If you don't have the foundation to be able to build something, then that's when you feel that trading could be just grasping straws. And it feels like you're just doing things on the fly and trying to learn along the way when things were to happen. That's exactly how I began to trade. When I began this industry, I had no teacher. I think you heard Edward earlier on. He said that my father was a technical analyst, and that helped me a lot. He started teaching me when I was 12 years old. At 12 years old, he would say, Juanis, come here. Can you please show me an ascending triangle in that picture? And a 12-year-old would go to my dad and say, what? And I didn't understand any of this. All I wanted to do was run outside and play, and I never wanted to get into the stock market anymore because next thing I knew, I had stock market for breakfast, for lunch, for dinner. And I said, never in my life am I going in here. And here I am. Well, learning how to trade was exciting. My very first trade, lucky for me, was a very fruitful one. I bought a company called ABS-CBN. Why did I buy it? I bought it because I said, wow, one of the country's biggest TV stations. I always watch them every day, so I thought that because of that, that should make everything happen, and I bought it. When I bought it, the stock plummeted. Not because the price adjusted, because they gave a 50% stock dividend, and I didn't know what it was. So you imagine if you're in my shoes, I bought a stock, the stock starts to fall down by so much, and apparently there was a dividend, which I had no idea what the dividend was. And it was the first agonizing lesson I had. Of course, a few days later, somebody told me, don't worry about it, you're getting these new shares later on. But it taught me a serious lesson that I was jumping into an environment I was not prepared for. And I said, that was the very first day. I said, eventually I made money in the stock, but it said preparation is everything in here. And I had to be able to involve learning how to do all this because it wasn't just that simple. And that's why, of course, a lengthy period of learning attempted to come in. So our first side of all this is how do I get myself aligned with the market so that I know what the market has in expectation for me? If I just go buy and sell and have no idea what the market is going to have in store for me, then that's trading blindly. And you really have to fix that as soon as you can. So being able to prepare yourself for these particular types of trades would really endeavor for you to be able to understand these 3 basic things. Good trades will stem from, 1, being aligned with the market environment. And that's your first mission. Because before you start going and say, all right, I'm going to use this, I'm going to use that, I'm going to use this. But let's say, for example, you decide to go trading momentum style, which is a very fast trading movement, trying to look for those 90 degrees they were talking about earlier on. And here you are going into a sideways market, which does not warrant it. And now you're going to say, oh, this doesn't work, this is hogwash, I'll throw away technical analysis. Well, you see, you're using the wrong tools at that time. And that's why certain things have to be fixed up front. Second, please know what you are buying. Now, we might be talking about technicals today, but do not leave behind the fact that the company that you're buying has to be very much known to you. And you have to know, who are these people? How strong is that business? Am I buying it because there is growth in this company? Or are you just buying it, ang ganda ng chart, bibili ko na yan. Yes, the price might involve itself, but the surprises will come from these. Or if something fundamental comes out of the picture and you're there in their, in the exposure of whatever it is that they give you. So please know your company. 3, craft your trading plan. Trading is very emotional. As you get involved in something like this, something happens. Prices go up, or they go down, or they go sideways. Imagine, never mind if you buy a stock by chance. You just say you just decided to buy one. And then you're going to say, all right, I bought this stock. It starts to go up. You pat yourself on the shoulder, and you say, ang galing ko naman. And then you buy another one, and you just happen to make money, and you say, oh man, I'm really good. And then you buy the third one, and it goes the opposite direction. You say, why did you do that? It's not supposed to do that. And then as it starts to fall down, you say, what do I do now? I'm almost sure that third question is what you keep asking yourself mostly nowadays. And so, again, that preparation of the mind becomes very important, because once you build a trading plan where you say, I'm going to do this if this happens, then it's very hard for things to go wrong here. If you do lose, it's going to be calculated, limited, measured. When you make money, it's there because you intended for that to happen, because you prepared for it. And so, if this is the good side, this is the bad side. And the bad side for understanding these trades is you are completely deaf to what noise the market is giving. Here it is, market's telling you something, or for example, Edward earlier talked about if interest rates are going up or going down, that might play out affecting the market in a certain condition. If you're not listening to that tune, then you're not unprepared for what's to happen. Right? Next is, if you don't know whether the stock is good, bad, or getting bad, then that's going to be another surprising feat as well. Can you imagine what happens when these guys make all these kinds of decisions? I think earlier they were talking about CHP. Well, it went to 2 very difficult decision processes, and it's because of that that the stock price attempted to fall down. So you have to be prepared for that. And if you're not, you have to prepare, like Lauren says, you have to be prepared for the eventuality just in case. And that's where building the trading plan becomes very, very much in context. Because in the end, what you need is control. You need control. That seatbelt must be fastened. But you must be turning the wheel of the car to get to where you want to go. Because when you have a hard time, you don't have the luxury of looking for somebody else and say, oh, pare, anong gagawin ko dito? No. You are the maker of your own success. There's nobody in this room who's going to help you do that. Especially when it's happening at that time at your home when the stock is moving up or down and you can't seem to make a call. You have to build that skill. And that skill takes practice, resilience, and the ability to rebound sometimes when you make a mistake. Making mistakes here is part of our lesson. And so, by putting all these quantifiable things back into place, that's when you begin being able to mobilize yourself. So we said, first things first, know your environment. Now, the environment shouldn't be too hard to piece in. Your market will go through roughly 4 phases, and it's your job to understand where we are in those phases. For example, if we have that quadrant you see up here in the slide, the market will go from a period that is a weak bull situation to a very strong bull market, then to a weak bear market, and then to a very strong bear market. And it cycles through this over and over again. Now the question is, where do you think we are today? If you're having difficulty in your trading account now, that means you are not in a strong bull market. Because if you were, anything you buy would fly. If you're having difficulty now, you're not in a strong bull. But are we in a bullish market or a bearish market? Can you even tell that? What do you think? Bullish. I only heard a small portion of you say, but how many of you guys think it's a bull market? You see, I just saw you create a trend. You waited for people up front to raise their hand. Next thing I saw the hand go backwards this way, right? And that's sometimes how the market is. I want you to remember what just happened right now. Because when the market is in that situation, like it feels like you're in limbo, nobody wants to pull the gun. Nobody wants to press that button to activate. They're always waiting for other people to do it. And so that means, unfortunately, maybe the market needs to break out over 8,000 to incite many of you to do something else. Right? So remember, what you're waiting for is for other people to start the car to move before you get aboard. So by that time you get aboard, that means the car has already run a certain distance. And unfortunately, that's the reality of many traders. Until one day you gain that confidence and skill level where you can initiate. Right? Today, we are in a weak bull environment. Okay? It doesn't matter whether you're growing by 6.3% GDP. The market is telling you we are. There's still some things there the market's pricing in, and that's the reason why we've been so slow. And given that you are in a weak bull environment, what type of market movement are you going to be feeling? Restraint. And that's the reason I'm giving this talk today. Believe you me, I would not volunteer to talk about trading in ranges. It is unexciting, but it is a necessary evil. Like the lady said earlier, the market spends most of its time consolidating and moving in channels than what you're going to be learning in that other room. What you're going to be learning in that other room is a fragment of trading time and may happen once in maybe or twice in a year per stock. So what opportunity will you find unless you're waiting for that? Unless you're like our chairman who likes to wait for a crisis. Okay? So in that condition, we are in the condition we are today. How do I make the most of it? And that is where we're going to be stepping off today. This is the performance of the Philippine Stock Exchange Index. And if you're looking at that graph there, you can see this dotted line you see there in the middle is the 0% indicator. So that means if that goes to 0, it means the index is flat for the period. This is a 3-year chart. So that means taking from the beginning portion of 3 years ago, going down the lane. If you're looking at the market performance in the last 3 years, it's only been negative for a while here in the end of 2017 and a little bit there in the end of 2018. Other than that, the market's actually been positive. However, it's been going up and then down, then up and then down within that period. Some a little stronger when you saw over here towards the beginning of 2018. And so what that tells us is the market is stuck in this revolving range. And because of that revolving range, we have to understand that this market's not about to run away, at least not above those high percentages just yet, because clearly it's dealing with something. And so the choices we have when we become a trader is to be able to focus now on a certain trading style. So the graph that you see here, the layout, will tell you what is the trading environment that you have and what type of trading tool should I be using in that particular type of environment. Now, since I told you today, we are, majority of the time, we're going to be stuck in here in a range type of environment, that means that I'm going to have to be able to get used to it. That I'm going to see flat movements and very graduated moves and not, grand spanking momentum-like movements, at least not yet. And so in that environment, we're going to have to get used to range trading, maybe even some swing trading, but momentum runs, it's not the flavor of the month. And so by understanding that, we temper our aggressiveness into this market condition, and we try to be able to highlight what we do in this ranged environment. Now, as markets spend time in that condition, where it stays mostly in ranges, we're going to see capped movements, either sideways, like you see there on the right side, or maybe a little slight angle upwards to that fact. But that movement, like a rocket ship, if you do see it, you have to take your profits because it's not going to last. Okay? Gone are the days where we've had issues where you'd see the stock go up 50%, the stock price freezes, tomorrow it goes up another 50%, and it freezes, and then goes another 50%, and it freezes, and people are still buying it every day. When is the last time you felt that? It's been a while, right? Because people got used to what they saw. Some people got burned. They now know better. And it's going to take time to sucker punch them back into a stock like that. And so we'll go and start from scratch because that's the way the market will have to behave. And if you don't understand this, and you continue to just be blind to what the market condition, this is where you're going to be asking help from the Almighty up there. Okay? Remember, I always say at the end of my seminars that God helps those who help themselves. That's right. So, ladies and gentlemen, the task is upon you to be able to create that trading facility for yourself where skill managed by your risk management tools is what's going to be your success ultimatum here. So let's deal with our ranged reality. Now, you might ask, for heaven's sakes, why would markets always want to stay within a range? Well, markets come into a range for various reasons, right? You can see. The first one is because sometimes the swings that you see become too exaggerated. When a stock price climbs up too much, try to understand that you are not the only buyer there. There are many people who bought that stock a few days ago, a few weeks ago. And as you accelerate the movement upwards, you're giving those people time and opportunity to take that profit. You might be entering now, but these guys are making tons of money. And if they're making tons of money, they can easily sell that. And that creates that cap and produces that reactive effect or sideways effect into the price. Second, trend transition. So sometimes it's the intent of a particular stock price to do one of two things. They go up because of exaggeration, they start to park, and as they go sideways, they're here telling you that after this, I'm either going to go back up again or I'm going to turn around and I'm going to head back down. So it's a pause point. The market needs to make a new decision. And as it's making that new decision, it creates this characteristic sidewinding range. And that one is something that can prove useful if you know what to be able to look at. We'll talk about that later when I deal with the area patterns. The third is fixed discrepancy in terms of being too expensive. This is not a fundamental talk, but I'm just giving you reasons why sometimes prices need to range. So for example, stock price goes up. It goes well beyond its fair value. And now it becomes quite expensive. Even the fundamentalists think it's expensive, and you're going to get a lot of profit-taking maneuvers coming into that. And that's a reason that you will also get some adjustments. People who are new are going to say, why would I buy that? It's kind of pricey. I'll buy some other stock. So automatically, there'll be less demand heading in that direction if the value proposition is not there. And last, the loss of demand or the loss of supply can also create these ranges. Why is there a loss of demand? It could not have anything to do with the stock. It could have everything to do with something else. For example, like Edward said, a crisis. Good company in a crisis, not too many people is going to want to buy that. Right? Because people become more risk averse. They say, oh, baka ito mangyari sa akin, so why am I going to buy this now? I'll stand back first, wait to see what happens. Automatically, wala na dun yung pangbili ninyo eh. And that will also cause a pause movement into price. And these are the reasons why you will see a lot of trading ranges attempt to appear. So, as an example, this is swing exaggeration. So, you get prices moving up very, very sharply. And as you see that the movements, for example, what you're seeing from this end down here all the way up to this area up there, very, very fast, and then prices just stop dead on the water, and then they start to cascade sideways. It creates a pattern. We call that a falling wedge. And that pattern attempts to pause prices for a while, but eventually prices rise back all over again. Right? And then shoots up, stops, cascades sideways all over again, and then pushes up once more. Wouldn't it be great if somebody could just look at something like that, someone like you in the back of your mind, who can just tell you, no, you enter just on this moment. Don't enter during that entire sideways moment. Because if it takes 3, 4, or 5 weeks to go sideways, that means you're going to have spent 3 or 4 or 5 weeks holding your stock, hoping it goes up. Imagine if you've been waiting 3, 4 weeks and then bumaba pa. And that's the worst. So what you want is to be able to make sure that you're in line with that it can still continue to be able to move higher from that particular movement. So remember, swing exaggeration will pause for a while. Trend transition. Here you have a downward moving chart. All of a sudden, it creates a base. Goes sideways for a while, and then eventually punches over resistance, and you have prices attempting to move on. So this particular type condition, you have to understand, happens because it takes time to turn a trend around. So if you have a strong upward moving market, before it starts falling down, that market will stop, turn sideways, cascade first, and then turn downwards. So remember, that works for many of the chart. I would say 90% of the time, that's what happens. The only reason you would get something out of that is when something completely spontaneous, maybe damaging or very buoyant to a company price that might be involved. And that's the only time you get something out of the normal. Okay? Next. The difficulty of you trying to figure out, is this expensive or not? Well, fortunately, we do have an investment guide. Some of the fair values of stocks are placed there. So if you want to be able to try to look for propositions in value, you check. So for example, BDO. Earlier, broke out 2 days ago, went from 133 pesos per share, 134, shot up all the way up to 140, 142 in 2 days. And then we get some pressure into the selling side. Its fair value is 130 pesos per share. So right now, BDO is not cheap. Yet, why is it moving? Right? There could be something else that's causing that instability to the price. But the minute whatever reasoning stops, it's going to eventually try to seek its way closer to that fair value. And that's why you're going to get gyrations and sideways movements into the price eventually. And, of course, the loss of demand or supply. So I think, look at this picture that you see here. It falls down, goes sideways first. Goes up, goes sideways, and then goes back down. And that's a clear example of how these transitory positions normally attempt to be able to move on. And you just have to be prepared for that. The learning lesson here is this. Once a pattern ranges, your style has to change. You become a bit more defensive because the market is not aggressive. And as it's figuring out what it wants to do next, you have to hang back and say, all right, I'm going to wait here on the sidelines unless there is an opportunity to make money in that range. And we'll talk about that in a little while. But in general, if that range particularly is very small and there's no way for you to make money, you hang back and wait for it to tell you what decision it's made. So a range market will show no directional tendency. Because you have to understand this. How do I know? Did the market go into a consolidation already? The beginning portion of a consolidation is tough because you think the market is still trending, yung pala, it's already gotten stuck. It's already feeling some quicksand, and many people don't even know about it yet. So the basic sense of it is that it's going to start moving sideways. In a case like this, you'll probably see prices moving from the bottom of this range, climbing all the way up here, and then you will feel your first high. Then it starts to pull back. Normally, in a strong uptrend, that's a particular topish movement. But in the first pullback, you will know how these ranges come in because normally the first thing it does is the first correction is deeper, usually deeper than all the other corrections you've seen earlier. Right? Then, as the range starts to flesh itself out, you will know when the first high, second, and the first low come up, you'll get an idea what the low and high range is, and then you start drafting, write your lines on the bottom and the high bands of it to be able to draw out your resistance and support. Okay, for the benefit of the people who don't know what that is, resistance is an area above the market It shows a lot of heavy selling. People want to sell at that price. And if there's a lot of people selling on that topish price, or in that particular high, let's say we're talking about the high like this one up here, that means there's a crowd out there who believes the price is right. It's time to sell. And they start selling their position. And that act of selling that they're doing is creating the hindrance in the price. That's what resistance is. If there's 10 of you in here who started, and 10 of you, like the way you functioned earlier on, let's say the first people here start selling, and then the people behind you say, oops, parang ayaw na umakyat ito ah. And then they say, oh sige, ako na rin magbebenta. As time goes on and you guys continue that, you start to convince a greater portion of the crowd to believe what you believe, and now they start selling, and all of the next thing you know, you have a major selling force standing in that line. That's what resistance is, the willingness for the crowd to sell. And that's why it creates a top. Then the stock price falls down to the bottom you see here, and the bottom, it starts to recover. What initiated that? Now there are people who are now believing, that looks like a good price already. Let's try doing some buying. And as you start doing some buying, the people behind you see that it doesn't want to fall down anymore, and they say, oops, maybe it's time for me to buy as well. And all of you now start switching, and you become more supportive of the price. That's why we call it support. And now there's an encouragement for prices to be able to rebound. If you see evidence of that twice, 3 times in a row, it's very clear to you that those ranges become very strong ranges to be able to use. If possible, you will be buying on the low and selling onto the high end of that range. But sometimes, those ranges may not be as flat as what you see at the first situation. Sometimes you'll see a more graduated approach. Okay? When gradual, it could be more channel-like, going up this way. And so you don't think that you'll be able to buy all the way back at the low. You will only know that once you have your second low appear. But you have to be prepared just in case they do. In today's environment, as I'm already telling you what's going to happen, you'll probably see more patterns that look like that. So be very much sensitive to those types of situations now. But there's a third. There's a situation where the range of the consolidation you're looking at will start to narrow. They will start to come towards each other. And the reason that happens is because the amount of shares that either want to be sold or bought, as a pattern completes itself, becomes smaller and smaller and smaller. And many times you will see ranges start to narrow this way. Once a pattern starts to become very narrow already, you're almost asking for prices to push itself above or beyond that particular price. And that's why we become more sensitive to a potential we call breakout scenario, which I will also teach you in a while. So roughly you will see these particular types of calibrations in terms of the patterns we are going to be using today. So one of the reasons that you would see that a potential range has come in is a drop in activity. You will see that once patterns get used to going up and down, the crowd becomes disinterested. And as they don't want to participate anymore, they automatically stop buying. So those people who are not making money in there will probably not sell. They're just going to try to wait it out. So if the buyer doesn't want to do anything and the seller wants to keep himself quiet until the next opportunity, automatically the volume or the number of shares that trade in a stock in a day will start to gradually diminish. Nice thing about that is as the volume levels start to diminish, when you see that the volume levels, for example, in this area here, start to become relatively small already, and that tells you that sleeping giant is getting ready to wake up. Because there's no more shares to be had. If I'm a buyer and a seller, and I want to buy or sell in any grand way, the only way I can do that, if I'm a buyer, I will have to look for the people who want to sell at a higher price. Because nobody wants to sell in there anymore. If I'm a seller and I cannot find buyers in that range, I have no choice. I'm going to have to smash that stock down to be able to get out because nobody wants to buy the price from me anymore. So a drop in volume is a potentially positive thing, positive in the sense that it's telling you that the range is getting ready to end. Okay? Second, I'll introduce an indicator to you today. Some of you may know this already, but there is an indicator out there called the DMI. Now, the DMI has an indicator inside it called an ADX. The ADX is the line that you see here that I've drawn. That's this line you see here. Oops. Okay, this line that you see here in the bottom. Think of it this way. It's like a temperature gauge as well. That particular indicator simply measures this. It checks to see whether your market has force or doesn't have force. It's not telling you direction. It's only telling you, malakas ba yung movement nito or medyo mabagal? If the ADX reading is below 25, that means you're more likely in a ranged environment because you're a very slow momentum-based market here. If the ADX is above 25, particularly above 30, then that means you are in a momentum situation. That means malakas yung sipa nito. So if you see a stock and you're seeing below 25 readings in ADX, more likely you are in a range situation, and channels are your best option here, if not flat movements into your market. That way you have a cheat sheet. You can tell right away whether this stock will be a runner or whether it'll be a cascading move. Just look at your ADX. Next, you will also see a trigger of a range when a trend line is broken. So in this particular case, you see a trend line been drawn in your chart. A trend line is a line that follows a trend. We normally draw it by connecting the bottoms of a chart in an uptrend, and we connect the tops of a chart in a downtrend. A trend line is a tool we use to be able to give us a gauge to see whether the trend is intact or not. Once a trend line breaks, it tells you that that advance you're seeing has stopped. Okay? And as the trend line gives you that signal, more likely, like I told you earlier, an uptrend will go sideways first before giving you a new decision to either go higher or go back lower. So a trend line break is a good exercise to check. If some of you know how to use moving averages, you can replace a trend line with a moving average. Now, moving averages may be drawn in various day sizes. And the ones that I've pointed out over here, we have a 20-day and a 50-day EMA, or exponential moving average. If you notice, they kind of mirror where the trend line is. And if the price attempts to be able to break below it, just like you see in this area here, that means, just like a trend line break, the moving average break can tell you that the trend has slowed down and it's now going into a range. Another thing that you can also do with a moving average to be able to tell you whether your market is ranging or not, remember a moving average, the keyword average. So if I have a sideways moving market and I have this average coming along with me, where should an average price be in a sideways range? Where should an average be in a sideways range? At the bottom, at the middle, or at the top? At the middle. So when you see a range, you will automatically see the moving averages are starting to flatten in the center or near the center of the range, and you see prices going above it, below it, above it, below it, above it, below it. Now you know you're in a range too. Now remember, we're teaching you how to notice the ranges, because if you don't know you're in a range environment, you're going to be whacking momentum style in a flat market. And that's something that you have to make an adjustment right away. Because believe it or not, more people lose more money in a sideways range than in a decline. Do you believe that stat or not? Again, more people lose money in a sideways range than into a decline. You want to know why? Because when the price starts to fall, matatakot ka na, bebenta mo na yung position mo. In a sideways range, you're still doing this. And you're hoping for prices to be able to resuscitate itself. Some of you, of course, are trying your best to buy and sell, but maybe if you don't know what the typical rules are, you have a hard time. And the losses you take in a sideways range is graduated also. You don't take big losses in a range, it's tiny losses. But you do 2, then you do 3, then you do 4, then you do 5. After the 5th, you're going to say, ayaw ko na. And you never take that money back until you engage into a new trade. And last indicator you have that the range has or is in session is when all your momentum or swing readings are all starting to prove quite erratic. Your MACD, for example, if some of you know how to use this, the MACD you see here on the bottom, look at this. Buy, then almost immediately sell. Again, buy, almost immediately another sell. And you say, if I'm following this indicator, I'm not going to make money. So the minute a momentum reading starts to go, erroneous, it's because the market it's trying to be able to fathom is not in momentum mode anymore. It's sidewards. And so I go to great lengths to be able to do this so that you know and you can identify when a market is ranged. Now that you know a market is ranging, you know already what you have to do. Aggressiveness goes down. I should be buying low and selling high. I shouldn't be chasing prices anymore. And now you've much fixed a lot of the problems that you normally encounter in a market environment like this. Now you guys have been given an exercise sheet. Okay? Now, inside that sheet, I put an example of a chart there. So this is AGI, which I have up front. Now, I'll ask some questions for you. Try to be able to put your answer down before I give you the answer. I want you to write it down so that it's touch move for you. You don't just tell, ginawa ko, tama pala ako. Yung pala, you were answering the opposite condition. All right, so I have a chart of AGI here. Now, let me just present the facts. A trend line was broken here. The price is standing below the moving averages. The ADX is reading at roughly 25, so right smack in the middle of that threshold I gave you earlier on. And if you look at the MACD reading right now is in sell mode going below the zero line, which is indicating it looks like I'm heading toward a corrective drive here, possibly into a new renewed downtrend. Now, my question is this. Will AGI likely rally or range? So just study the facts first. Just look at the big picture. If I were to take all the lines out there, just look at the price chart first. Is the trend up or down? Up. Okay. So remember, your bias has to be in that direction. So I'm in an uptrend, but I'm taking a pause. But now, will this be a long pause? In other words, will a consolidation come out or a range? Or do you think this has the capacity to be able to recover? I guess that's the question. Given the indications now you add to this chart, should be able to give you a better assessment of what is to happen in this. Do you have your answers in? Okay. So I put ranged but up. Why did I do that? Now remember, it looks like you are in a corrective movement here, and that's something we're going to have to do, and that's a reason I say this is more likely going to range. But the bias of your trend is still underlyingly clear. You are still in an advancing swing here. Now earlier, in my talk earlier on, I told you normally corrections, when they normally carry themselves out, will come out in 3 swings. Normally what is known as an A wave, a rally B wave, and a C wave. After a 1, 2, 3 move, normally corrections end, and then now your stock price can normally attempt to be able to recover. I think that's what's going to happen over here. Now the reason I have to be able to be a bit more defensive, if not, I could have shown you just straight up, but I couldn't do that because the indications below are telling me, no, this cannot be that strong. Your momentum is not that strong. Your MACD is telling you to worry about it. So there might be more range action here before that. Okay? But clearly, this is not telling you this is going to go to a downtrend. Okay? That's not the indication here at all. What does it need to do to avert a ranged situation? So in other words, what should the price do to be able to tell you, nope, this is going to rally well already? What do you want the price to show you? Now remember this basic lesson, okay? When you're thinking of something to do in the technical world, it works this way. If the trigger for you to do something is no longer there, that means you stop what it is you're doing and you change your tactic. For example, if you see a sideways pattern and you see prices rupture and they break down, what are you supposed to do? Buy or sell? You see a pattern and it breaks down. What are you supposed to do? Buy or sell? Sell. If it goes back in the range, what do? Correct. Keep that question mark in your head. If it finally goes above the range, what do? Okay, so now if you guys are saying buy. So you see, you're simply working on a trigger response. So the same thing here. You're feeling worried because you see a trend line break. So I ask you again, what do you want that stock price to do to tell you more likely it's not going to range anymore and that it can continue to rally? The answer? You want the price to go above that trend line to tell you that it's recovered that point of weakness and that more likely you're going to see a recovery back to the previous high. That's the earliest you will trigger a buy. Okay? And you'll have to treat that particular type of condition that way. All right, let's get moving. I think you know the answer to this. Unfortunately, they made us give all our presentations several days ago. So you have a stock here that you know what's about to happen because you saw what happened in the last 2 days. This is BDO. The question here is, will BDO break out of its range, keyword, durably? Now, will it break out? Yes, it did. As you know, BDO went up to 142 pesos, closed somewhere 140. So it's still above that range. But the question I'm asking you is, will it stay there or will it go back in? So again, look at all the indications that you have. So you will see here, your ADX is below 25. That means you're in a weak momentum environment. Your MACD is actually giving you a buy signal. So that means, should I have bought the breakout? Yes. Should I anticipate that BDO is going to go way over? That's going to be the next question. So in terms of the first question, yes. Second question, if it does break out, will it break over 142? That's the high that you see in this area up here. So as it pushes out here, will it go over this high? And it says here as an answer, will it go above there? More likely, no. So what will happen is it'll hit that area and you will encounter resistance and you will see prices attempt to be able to move sideways. Okay? So how would I know that? That this is where momentum comes inside. You see what happens since you know what the trading environment is, and then you can apply that to that particular type of context. If I was in a momentum environment, in other words, the market's climbing up very fast, the answer to this would have been buy on breakout, buy after the next high, and buy again, and buy and close your eyes until you cannot buy anymore. I don't know if some of you have experienced a momentum market, but believe me, it's phenomenal. It rarely pulls back. And if you don't take it aggressively, you will never be able to buy the stock. And you're going to wait there. You're going to say, come on, correct. Ayaw talaga. And then it moves up, and you're waiting there. So, what's going on here? And as it moves up and up and up, you're just going to find yourself, oh my God, everybody else is making money except me. And finally, on the day that you convince yourself to buy, why are you laughing? Oh, it's happened to you. That's when the correction comes. Because you're the last one in the game. And when everybody, Tom, Dick, and you has finally bought, that's the time the price will adjust. I hate to tell that reality, but that's what happens. So try to be early into that particular stage, especially if you're in a range environment like this. Okay, so in a range environment, what do we do? The prospect really here is all about, we're going to be in a boxed range, either flat or, like I told you, maybe a little bit cascading upwards, and maybe even a narrowing range that can come out of it. So the whole idea is buying support, selling towards resistance. And the trick to doing this is this way. It is preferable that if you're going to buy closer to support, you do it after it bounces from support, not before. Because you want evidence that the price is telling you, okay, I'm stabilizing here and I'm going to try to be able to recapture my advance. If you buy it on the way down, you could be that exceptionally lucky individual who happens to buy the support, just happens to break. Right? So you wait for prices to rebound of support. Yes, you might sacrifice a few points. And yes, you might not to buy the absolute low. Ladies and gentlemen, I'm not here to teach you to buy the absolute low. I myself cannot do that. All right? The idea is to make sure you're buying near enough the row, but you're buying a little insurance policy to make sure that hindi yan masisira. Because if that support breaks, the cradle will fall. And you know what happens when the cradle fell, right? And so try to protect yourself in that manner. Second, when you see prices rallying towards resistance, do not wait for resistance to stop you. As it gets closer to the range highs, lighten down. Don't sell everything. Lighten down. So you buy on the rebound, sell it as it comes closer to the top, but you keep some. Yan ang baon mo, just in case tumuloy. If it doesn't, that's when you sell the rest. And the reason I want you to do it that way is because normally the people who wait for resistance to block the price, on the day that things start to turn down, it will fall down fast, the volumes will run away, it will be very hard for you to get out a meaningful position out in a reaction. So dapat mauna kayo. On that way up to resistance, you toss the position out already. Take half out if you wish. Keep some or half. If it happens to break out, that's a new trend. Engage a new strategy. All right? That's the way you would do this. Second point. Please only trade ranges that are large. The size of a pattern is meaningful. If, for example, you're looking at a range of, let's say, you're buying a 10 peso stock and the range of it, the high and low, is 2 pesos in size of a 10 peso stock, that's a 20% move. And you can clearly make money buying the low and selling the high in a case like that. But let's say you have a range, and your range is from 10 pesos to 10 pesos and 30 centavos. Can you make money? Buy at 10, sell at 10.30. Can you make money? I can. Who's I? Who's I? The broker. Okay, not you. That's very hard to make money in the size of that range. So it has to be a wide range for you to range trade. Third, please, don't ever leave home without it. You must have a protective stop. It is a tool that you will put into the supportive element, the bottom of your chart. And if somehow that range breaks, you have to learn how to cut your position out. If a stop leads to a loss, You just have to be, adult enough to be able to take that. Sometimes losses here have to be taken to prevent a big loss. I think Lawrence presented a very clear case of that earlier on. Earlier, I talked to a lady who met me outside. I will not say who she is, but I think her story should be told. She met me, not exactly sure how many months ago, or was it a year or more ago, and she was in a predicament. She bought a particular stock that kept on going down and down and down and down. No, it wasn't CHP. That stock did not want to reverse, no matter how well it went through. It was double digit, it's now single digit and counting. And my advice to her was, as hard as it could be, I told her, the best thing for you to do is to switch that position out. It's not making money for you. There might be something wrong. It could be underlyingly a reason why the stock is sliding. Now, you don't have any control of that vehicle anymore. You're in a car, someone's doing the driving, and you can't somehow stop it. So if you want to be able to rectify this position, the very first thing you do is stop the bleeding. Because it's the bleeding that creates an unstable mind. A trader cannot recover while he's wounded and bleeding. So the first rule, stop it. Put a patch on that. Sell that position. At that moment, it might be hard. But the minute you do it and you transfer it to something else, that notion of grief becomes hope. A better sense of it. Because now you've realigned yourself to something better that can recover itself. And I was glad to find out. She approached me earlier on, and she said, "Thank you for telling me to switch. I've switched it, and fortunately, I switched it at the time the market was coming from a low, and the issue she bought is recovering faster than that other one that she had let go, even up to today." A hard decision, but today, at least her life has improved because of that. And so here, it's the same thing. You have to learn how to limit your losses. Trading is all about that. By putting yourself in the right condition and making sure, just in case things go wrong, you've limited the impact of that damage on you. So here's an example of a big range. Here's a stock going up and down, up and down. Now remember, the whole proposition here is to try to get yourself buying at the lower bands of this range and try to sell it closer to the top end of this range here. While that pattern is in effect, your mind should be fixated that this is a range and I should treat it as a range. I don't want you to be that person that every time it goes up to the high band, you're going to say, oh, yun na, mag-breakout na siya. So if it does that 6-7 times, and there you were, as the price are going up, you didn't sell it because, no, this is it, the chance of a lifetime, it's going to do it now. And then it turns down. Your mind is fixated on holding the stock because you think it's going to break out, and you're not doing what you're supposed to, taking that profit. You enter the transaction, you enter the trade thinking it's a range, and when it finally gets to the upper bound of the range, you're treating it as if it's going to break out. You're changing your plan. And that changing of a plan will result to something very erroneous. That's why people have a hard time. They let their emotions get into the way. One day it will break out. Or who knows, maybe break down. But the minute it breaks out, your range trading style stops. Now trending momentum comes back into place. Now change your style, be more forceful. And that, unfortunately, is what a trader is going to have to learn how to do. How to switch on range, trade, range, trade. It's not easy, but it's something that you would get when you do it more often. Right? I know what you want to do. Why can't I just use one style for fit all? It's not. It's like our weather outside. Sometimes it's sunny, sometimes it's rainy. I hate bringing an umbrella with me. Well, what are you going to do? It's raining. You have to adjust. And that's the same adjustment you make as a trader here. Here you have a situation, you have another pattern building. It starts in the building quite wide, and eventually over time it's getting narrower and narrower. So in a condition like that, you also have to make an adjustment. Go ahead, you can buy and sell, as long as the range warrants it. If it starts to become too narrow, and you can see it's hard for me to make money, then this is the decision you're going to have to make. One, if you're holding the stock, you ask yourself, am I prepared to hold this in case this takes 1 or 2 or 3 more months? If you're going to say no, take it out. If the range becomes too narrow, you can say either take it out or I'll hold it and I will only get out of this if the low of that pattern will break. But you decide that then. You cannot just be doing that in any point in time. It has to be when that range has narrowed enough because you know you cannot buy and sell and make good money anymore. So let's look at this as a particular example. So here we have a movement of a stock, right? I think this is SSI. Range started wide, becoming a little bit narrow. If you notice the point 1, point 2 of this particular pattern, right? Point 2 is already showing you the range is becoming a little bit narrow. But now the price starts to rush, and it's come closer to that area now. And more likely, as I pointed out earlier on, as the range starts to narrow, that starts to wind up, and it becomes a looming potential to break out of the pattern. And sometimes you might get clues from the area pattern of that pattern as you would look at it. So in a case like this, if it's too narrow, you cannot buy and sell that anymore. If you buy that, you will hold it, and you're going to opt already for a potential breakout there. And you will only sell it if it cracks the low. That's the way to do it. All right? Next, if you're going to buy that and you're going to hold it, please make sure that you put the necessary support stops in place. It is commonly used that the lows of the patterns are used as the stopping points of the transactions. So for example, in this particular case, the lows here is what people normally use. Now it works this way. If I bought this stock here, my stop will be down here. If I bought it on this rally here, my stop will be on the previous low. If I'm buying it here, it will be on this low over here. That's how you choose. Okay? Now, if the lows happen to be very near each other, I'm saying really near, I'm not talking about 3-5% near, I'm talking about very near, then you could use the last low of the 3 set. But if you're talking about a difference of more than, let's say, 1 or 3%, try to use the low closest to you. Okay? All right. Now, once you come around to be able to do that, and let's say that thing breaks support, forget it. I told you, the reason you're buying that stock is no longer there. If that means you're not supposed to be buying the stock and it breaks support, please exit your position. If it leads to the loss, sorry na lang. That's just one out of many trades you're going to have. Put it in. Cherish that as an experience. Or like Lauren said, charge it in because you've just learned something new and try to learn from that mistake as you move forward. All right. I want you to be able to look at your exercise sheet again. And there's a stock price here. This, by the way, in case you want to know what it is, or maybe I'll tell you what it is later, para wala kayong bias. First question. Would buying the stock at point B be good as a trade? I'm assuming if you're going to buy it at B, you're thinking it will rally to what letter? C. Okay. So that's what we're trying to fathom here. Is it okay for me to buy B with a target of C? Answer? Yes. Why? Well, because if I buy at B, my target is C. What is my risk? My risk is if I buy it at this point and it breaks only this little small part here, I'm going to take a very, very small loss. Right? So my upside is bigger than my downside. That is the type of risk reward you want. It has to be higher than your potential risk. That's what you have to get involved looking for. Would it be right to buy B, placing a stop at point A? So that means, is it okay for me to buy here? And I will only be wrong if this goes below, let me see if we can get this guy running. This. So dito kayo bibili. If it falls below A, you get out. Because your argument, oh, kasi the big entire pattern broke already. The right trade would have been, wait for it to fall to A, let it bounce, buy it there, and put the stop below A. But buying B is not correct if you use a stop A. And the reason for that is my upside, which is C, is just equivalent to my downside, which is B to A. So it's lousy risk-reward ratio. So underlyingly, when you're looking at the potential to enter a trade, it's all about trying to say, does this have bigger upside than my risk? And if you have that condition, then that's what you're going to have to learn how to follow. Okay? All right. Look at this chart. Question? Is it good trade to enter at point A? When I say A, that means it has to break over A. So again, if you buy A, what are you targeting? B, okay. And if you buy over A, what will your stop loss be? Where will you put it? Remember, stop loss should be placed at support. So if you're buying at point A, where should you put your cut loss? It cannot be A. It's not support. Where is support? At 1. That's correct. Your support's down here. So buying here, upside B, downside here. So answer? No. 1, my reward is very limited. My downside just become big. And again, this is how you're going to try to make an assessment of a particular pattern. Second question. All right. Which is, notice the word, sensible stop? Assuming we buy near area 1. Do I put it in point 1? Do I put it in letter B, which is point 2 or 3? Or do I put it all the way down 4 or number 5? That way, hindi ako ma-stop out. Answer? B. Remember, I said earlier, if you're looking at the stop price, you want to be able to try to move that stop to an area not so far away from your original, just to be able to give you some leeway to be correct. Because, I know you want to make risk as tight as possible. But let me give you guys good news. You are not the only people in this entire environment who understand technical analysis. There are some people out there who are very crafty individuals. They know what you see. They know where your stop is. 90% of a new trader will put their stop in number 1. Okay? So you know what some of these guys are going to do? I've seen some of them do it, so don't tell me they don't exist. I will purposely break point 1 just to get you guys out. And then, ako yung bumibili sa ilalim. And then I will push the stop. After you cut your loss, they buy it, push it, forcing you to buy back your stock, and you will be the one elevating it for them. Right? And you read about something called crocodile trading, and you'll see what I mean. That's where they try to snap you up. So the answer here is move it to a stop not so far away that has a little allowance. Anyway, that's not a so big a percentage more than the other one. But you know that if those two break, that's something serious going on here. Now, if that were 5-10% lower, please don't do that. Keep it in number one. But if it's near enough, use the other ones so that you can have some allowance to be correct as well. Okay. Next, let's talk a bit about area patterns. Now, some of you who've attended my technical analysis seminar, some of you have probably seen this, but a vast majority of the crowd here have not attended one, so I'm going to have to clarify some matters. You see, when we're looking at these particular things, area patterns are these pause points in the consolidation chart where they go sideways. There are two types. We have one called a continuation pattern, and we have one called a reversal pattern. If you noticed, our president earlier said that there was this poster that you guys were given, right? If some of you are just keeping it roll dip and you're going to have it there, please, if you guys want to be able to be a solid trader, you got to know what those patterns are. And that's the reason they put that into poster form so that you can just see it and mentally you can absorb what these patterns are. And I'll teach you what they mean in a little bit. So there are two types of area patterns in classification, continuations and reversals. A continuation is simply this. Here comes a trend going up, goes sideways for a while, stops, and then moves up again. So it continued the trend that it had just done. Another type is what we call a reversal. So it goes up, goes sideways, and then turns the opposite way, just like the picture you see there on the right side. The reason we want to know that is because it wants to be able to tell you, remember this, there are two exit points from a pattern, not just one. So if you know that, once an area pattern comes in, don't you believe that it will automatically go up. Remember, there's a potential it could reverse and go the opposite direction. So you can only act when you feel and you can see evidence that it's really pretty much going into that next direction that you anticipate. If you don't have that sense and you can't feel excited about it because it doesn't give you that, then you're not supposed to act in anticipation. Okay? You have to be more likely sure rather than just casting yourself in there. All right. Now here you can get some clues. The shape of a pattern. The shape of a pattern is seen after you draw your support and resistance lines. So in this particular case, there are two lines on the first one. If you notice that the resistance line here is flat, the support line here in the bottom is also flat. Now, when the lines of resistance and support are flat, a flat line in your support line or resistance means that the buyer, and in this case the seller, they just want to sell or buy at that price. They're not interested in pushing here or demolishing whatever. They just want to buy or sell at that price. For example, how can that happen? Let's say, for example, have you ever put a GTC order? You put a GTC order, and now the reason you put a GTC order, or good till canceled order, is because you say, all right, if ever the price goes up to this price, sell my position. Sometimes it'll hit it, sometimes it will complete it in one go, sometimes it might take 1, 2, 3 days before you complete a GTC order, especially if it's big. So what it simply means is, as long as the price goes to that area, okay ka na. You want to liquidate that position. And imagine if many of you guys are doing the same thing. So that needful to be able to sell that position comes over time. And that's why you're putting a flat resistance or cap. You're not adjusting that every day. Similarly on support, if you want to buy a stock at 10 pesos and you don't want to raise it to 12, then the demand will only show at 10. And that's when a flat level of line of support will appear. Now, the reason I'm telling you this is because the shape of those two lines can give you advanced reading of what's about to happen in your stock. Now, you think about it. If, for example, I have this non-aggressive buyer and non-aggressive seller facing each other in a sideways range. If you're both non-aggressive, that means the stock will just go up and down, up and down, up and down, because neither one of you are pushing against each other. But look at the next chart. Here, you have a flat resistance line. And your flat resistance line is telling you non-aggressive seller. But look below. Your line here is going upwards. And as support is pointing up this way, that's telling you that the buyer is willing to raise his price. He's becoming more aggressive. Now, he's becoming more aggressive because he might need to buy that in a short period of time. For example, if I was a big broker and I give my let's say I give fund manager and I give my broker an order to buy, I'll tell him, okay, broker A, buy me that stock. I want you to buy me 10 million shares of Ayala Land, and I'll give you 1 week to do it. So since there's a definite time involved there, the broker's going to say, all right, I'll buy it little by little over time. But if I find out that I cannot buy all those shares at one price, remember, I only have a week to carry this out. So what will I do? I'll be raising my price little by little because I'm going to try to finish my buying in that schedule. So buying becomes more aggressive. The willingness to push the price comes in. So now you face the two forces against each other. You have an aggressive buyer coming in, pushing. Well, the seller's just there, taking his own time, selling at the same price. Eventually, you're going to reach him. And as you reach that, you will easily take out the supply levels above you. So the potential to move out of a pattern like what you see here in the bottom, this potentially could go higher rather than either way. So there's greater chances of this pushing up than it is pushing down. And here is where the shape of a pattern tells you or gives you better insight as to what's about to happen to that stock. More likely, this is going higher. This is called an ascending triangle, where the first one is called a rectangle pattern. So by knowing the attributes or the shape of a pattern gives you clues as to which way the pattern will more likely go. And this is the reason that you will have that poster now, because in your poster you will find different patterns like this. If you notice your poster, I don't know if you've looked at it yet, it would look like this image that you have here on the right side. Now, we've arranged it so that you can see which one is a bullish pattern and bearish pattern. It's also been arranged so you can tell whether the pattern is something that will likely continue a trend or whether it will reverse a trend. That way, it's easier for you, so you have a nice big código to be able to use when you spot it. When you start looking for a pattern in a graph, please don't look at this poster and say, ano ito? Double tap. Tignan ko nga, kung mahanap ko itong. Believe me, you're going to find one, even if it's not there. All right? So the way to look for a pattern is simply doing this. Look at your chart. And when you're looking for a chart, let's say you're looking at the first one here. Just mark out, oh, I see a top here, I see a top here, I only see one bottom so far. And then just mark it. Maybe you can mark out the tops in red dots, the bottoms you can mark out in blue or green dots, and then just connect them together. Once you connect these two together, then you say, all right, does this pattern exist in my poster? That's the better way to do it. Because if you do it the first way, we call that form fitting. You're putting your mind into a situation where it's going to manufacture a pattern even if it's not there. Right? So connect the tops, connect the bottoms, connect it to the line, and now take that shape and form to your poster and check, which one is it? That's the way you should use it. Okay? All right. So remember, put the lines of the pattern together. Let's go back to this this chart. And if you can see that the basic sense of it is, let's look at this one here. Here you have a flat bottom line. So that means the people buying here only want to buy at that level. The people selling are forcing the price down. Who will win this war? The seller or the buyer? The seller. And so use that to your advantage. So that at least here you can say, if I'm going to anticipate, then okay, that's an example of a deadly pattern. I don't want to be buying that one. Okay? So be careful of that particular pattern. Now, in terms of the reversal patterns, I think the only one thing I want you to memorize will be the first one. This by far, the double top or the inverse of this, the double bottom, is the most prominent reversal pattern there is. Some of you like looking for the head and shoulders. If you find one, good luck. It'll happen every once in a while only. Although somehow when people look at, wow, Juanis, I spotted the head and shoulder. Congratulations. Right? But the double top or the double bottom are the one you memorize because 90% of those reversals stem from that pattern. This is actually a double top. It just has a slightly lower high than the previous one. So if you spot this part of a head and shoulder, it's like spotting a double top anyway. So just focus on that. And just remember this point in fact. When a market hits a high, that's a trend movement going up. From a trend, strong uptrend, it will stop. And it will create a pattern first. And so here's an example of a pattern. It hits a stop, makes a correction, climbs back to the previous high or near it, and then it reverses. So that is a pattern in itself. On the bottom, the same thing. It falls down, rallies, goes back to the previous low, and then it rallies. Most of the downtrends and uptrends you'll see will end using that pattern. And I'm telling you this because there's a need for that market to confirm that top is there. So uptrend, stop. It will just completely deteriorate. It'll rally, attempt to go back to that high to see if it can break it. If it cannot break it and it falls down, then you will see a wider correction come in. The market needs to confirm its movements. And it needs two highs or two lows to establish that there is a ceiling there or there is a floor here that can hold me. So that's why normally, after a plummet in price, I will never buy the first bounce. Never. You can convince me fundamentally as much as you want. And this was the reason that, if you notice, Edward came here. I said, Edward, why are you buying, what was the stock he was talking about? Petron, I think, at the time. And I said, it's catching a falling knife. And the only reason why it did not fall lower or even retest the low, the only reason was because Edward was there to buy it. He created the support. No, seriously, he was the only one. Everyone was selling it to him. And I remember his answer, don't worry, Juanis. Let that market take me out first. I said, grabe naman ito. Now that's a big man. Because he fought everybody else. At that time, Ayala Land was plummeting. All the other stocks were plummeting. And in the end, if he only allowed it to fall more, he could have bought that at a much lower price. But he said, no, take me out first. And fortunate for him, the market sold it what it would. He was able to buy it all. It did not fall down, and eventually it rallied. Although, like he told me, you know, Juanis, I came this close before running out of the cash I had allocated to buy that. Buti na lang, naubusan muna sila na hindi ako naubusan. And that's the reason why he turned out to be a success story for him. Okay. So now, look at this particular stock. What do you think I should do now? So the stock came in here. It did an area pattern here. Okay? If you notice, there's a flat top here. It broke out, fell back in, went back to the low end of the channel, then started to climb, and now it's up here. With what you've learned so far, should I be a buyer or should I be profit-taking? What? Profit-taking. If I had a position, how much should I profit take? Half. Okay. Let's see if you're right. Anybody knows what this stock is? Not yet? Okay, I won't tell you yet because I have to ask you one more question. You just told me you would profit take with half, correct? So half of your position had just made good money, but the other half is still there. And that's what just happened. What do I do now? Ah, now this is the part you don't like to answer. What should I do there? Remember, you have half your position in there. Do I buy or do I sell? You sell. You want to see what happens? We? You know what? That's the mission for today. I want you to go back to the market on Monday, and I want you to take away all the oohs in your trading life. Because it's that ooh that means you did not anticipate what was about to happen. Diba? Yan yung gulping gulat. Because you were not anticipating it and boom, you're there. If you're not anticipating and it's out of your realm of expectation, you're never going to know how to handle this. And here's where an uptrending stock turned around. Notice there's a big gap in prices here. See this? What normally causes something like that to happen? Why does the price just go from super nice, next thing you know, boom, it flatlines there? Why? What normally does that? What generates that? News. What type of news? Good news? Bad news. And after it did that, it didn't even want to rally. It went down, gap stayed sideways, and then now it cracked your trend line. Something's wrong. And then it does that. And then it does that. Now, my question to you is, if I still have it, what do I do? Okay, you sell. My next question to you is, when? Once? What did you guys say? You sell this when it comes rallying to that trend line, the red one. So if you see it rally back to the red line, benta na ninyo yan. Because this is just damage control already. You're not supposed to be there anymore. Just sell it at a better price. Don't be selling it when it's just, plummeting out like this. And you want to be able to sell it off the rally. So the volumes are better. It's easier for you to sell because you're not selling it at a crazy low. And so in a case like this, it can happen. This is GT Capital. Yeah, GT Cap. Right? Of course, they announced some news, clearly not good, and that's the reason why the stock attempted to reverse the way it did. All right. How do you know that the pattern is starting to end? Here are some readings. Volume begins to taper down. The narrowing of the range, as I mentioned to you earlier on, and the possible elevation or the degradation or a step down of the potential resistance. Let me just show you how that means. For example, look at this pattern of DNL. This has just happened not so long ago. Created a big pattern, right? Mind you, in case you don't know, insiders are buying the stock. By the way, do you know what an insider is? What is an insider? Usually, whom? The owners, okay? So if it's not owners, there's the stakeholders of the particular company. So here they've been buying and buying and buying this stock. I noticed all that buying happening while it was falling down here. They were still buying all the way here. Some of them were still buying over here. So if I'm just looking at insider action, wow, you might be saying, wow, there's a pattern going in and the insider is buying, right? And all of a sudden that happens. And you get a breakdown condition coming into it. So what happened here? Here's where some people were talking about, oops, somebody might be raising the price of palm oil somewhere and might wreak havoc into some of their earning strategies. And there's a reason why you have that. But not knowing that, let's look now here. As the pattern is continuing on, look at the volume going down. As the volume thins, remember, I told you earlier, at the end of a pattern, the volume dries up because there's no more shares to be bought or sold inside the range. So you see tiny movements in volume. You're getting ready. A little earthquake lang. Aandar na yung barko dyan. We just don't know whether it's up or down. But in this case, breakdown, step out. You can always go back to that pattern later when it looks better. But right now, in a breakdown condition, step out first and see what happens later. There are cases where I've seen a breakdown like that smash itself and eventually recover quite well. That's what happened to SSI. SSI broke down, fell down very, very sharply, but next thing you know, like a rocket ship went back up. Okay, it can happen. But the whole context here is protect yourself first. Don't allow yourself to get murdered by what the price will do to you. Now, here's another one. So, in this particular chart, you have a winding pattern that takes place somewhere over here, okay? And if you see this pattern here, this is what we call a rising wedge. It looks like a triangular pattern. It's starting to go up, 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 but the range of the pattern is starting to narrow. Now, the reason it narrows is because the buyer and seller are coming close head-to-head na. So if this was a fight between two people, they're getting into a fight, and at the end of it, mapapagod yung dalawa na yan eh. One will become the victor. And so as you're coming close to each other, they cannot anymore. They cannot, and people buying and selling cannot make money either. So a decision has to be made. So I've got normally a pattern. Very rarely will I see a pattern go all the way up to the tip and actually touch each other. It's very rare. When I say rare, I'm talking about 2% of the time. Most of it, you will all see patterns break before the completion of the apex. They normally will break in midstream of the pattern or maybe 3/4 away of the pattern. That's the time where the breakout will come. So that way you can also get some sensitivity to that. Also, look at the volume. You see the volume will also start to narrow before the breakdown took place. So use some of this learning so that you can say, oops, malapit na to. No more volume, the pattern's coming to an end. Now you're primed, you're now ready to be able to go into attack mode here or super defensive mode if you're holding the stock. But if you know what a rising wedge is, you should know already, that's a bearish pattern. Even though it looks like it's going up, that's a bearish pattern. Again, it's how would I know it's bearish? Yeah, pull up your poster and you'll see it there. Okay? All right. Now, the elevation of support or a step down in resistance. This is a good example of how you can get a little awareness that the breakout is getting ready to happen quite soon. You have a sideways pattern over here, and look what happens. After falling to the low, rally back, falls back to the low, rally back. And after the rally, parang ayaw na bumaba, oh. It just keeps going up and down, up and down, up and down, but it keeps knocking on resistance door. It says, come on, let me go, let me go, let me go. And eventually, resistance just suffocates. You take all the shares out of the market, and boom, the stock starts to be able to explode. It just happened. Bago lang ito. And so you see the movement upwards coming from SM prime. So this is a very good inclination. I'll tell you why this is different. As I pointed out this morning, that took almost 2 years to build. If you go sideways in 2 years ago, you'll see SM Prime has been going up and down in an 8 peso range. And only now did it come back to this high point, create a pattern like this, tightly near resistance, and that already gave me, I said, oh God, malapit na ito. So if I am an aggressive trader, I would build a position in here before the breakout. Why did I do that? One, because the tightening of the range near resistance. If I am buying this now here, okay, near this resistance area, my stop loss will be this na. It will no longer be the lower end of this range. So now I can control my risk, and if this breaks out of that big 8 peso range, whoa, that's good upside for me. Okay? So look at that. On the bearish side, look at this one. This was the stock I was telling you about earlier, the one that didn't want to climb no matter what. And look what happens. So look at this. It tries to go back to the previous top, falls down. Then next high is actually lower than this one. Rallies back to that, so you can see a new range. And then falls back down. Next thing you know, it rallies up to here na lang. And then it starts testing, and look, now we couldn't even rally. It's starting to flatline near support. At that point, believe me, all the warning signs were already blaring. And if you could just listen to that, you would have taken yourself off that sense of hope before that particular breakdown actually took place. So you have to pay attention to what these things are doing so that you can align yourself better into the context of that potential move. Okay. Now, one of the most difficult things people do is recognizing a chart pattern. All right? How many patterns do you see here? Can you see if you can draw a pattern in your exercise sheet? If you see any, can you please draw it? Okay, I'm coming off to the near of my end, but I'm running out of time, so I'm going to extend a little bit to make sure I drive the point clear here. How many patterns do you guys see? 0, 1, 2, 10? Anyone? Do you see the 10 patterns? Okay, you're laughing. Good, good. Okay, so how many do you see? How many? 3 or 4. Okay, you're going to have to teach me the other 2. Okay, there's an ascending triangle here, and there's a rectangle on top. Do you mind telling me what are the other 2 you guys found? Okay, remember the technique. Just mark out the tops and bottoms that you see are commonly near each other. Draw the line, and then call it for what it is. All right, that's a technique. Also remember this. Patterns don't usually appear when you see strong trends come. So it normally comes right after them. Remember, one of the reasons a pattern comes is because of trend exaggeration or swing exaggeration. So if you see a sharp up move, more likely a pattern will appear after that. And that's a staircase-like movement markets should make before when they come out. All right. Now let's go into this because I'm sure this is the part that you guys have been wanting to figure out for the longest time. All right. A breakout. Does anybody in this room does not know what a breakout is? Don't be shy. I was once like you. Okay. So a breakout is simply this. Prices pushing above, out of a consolidation range or a sideways range. An example of a breakout is this push right here at point 1. So you have a sideways range and prices are jumping above that. A breakdown, by the way, is the opposite. That's prices breaking on the lower end of that. And I'll show you an example of that later. Now, very basic. As the breakout takes place, you're supposed to buy. The reason of the consolidation is no longer there. I have to buy this stock because it's now attempting to move higher. Whether it's going to fail or not should be immaterial for now. The context for this learning is simple. If that breaks out, you buy. Okay? We'll just refine the point so that you'll know how to do that better later. Second, if you miss the breakout, you have another opportunity. If the price happens to turn back and goes back close to the breakout price, that's the next time for you to buy again, if you haven't already. Or if you bought a small amount the first time, when it comes back near your entry price earlier, you can buy some again later. Okay? That's the basic breakout technique and how to enter during that particular situation. Now, how do we know whether tutuloy ito o hindi? What's my confirmation? 1, there has to be good volume. Okay? Fundamental reasoning preferred. That means there must be a reason why it's moving. 3, prices are winding near that particular resistance zone. Right? So for example, this chart that you see here, it has all those elements. Now, the reason we want to see, for example, volume pick up like the way you see here is because as volume increases on a breakout, it tells you that people are following the breakout. May sumusunod. Hindi lang yung isang tao tumira lang, forced the price to break out, and then nobody went along with them. And that's a time when prices normally will come back in. So it's good to have that volume there. But one little tip, sometimes volume comes 1, 2, 3 days after the breakout. And what then? So I know a lot of people there who will not buy a breakout that has no volume. But what happens if the volume comes 1, 2, or 3 days later? And the price is already 2, 3, 4, 5% above. Mahuhuli kayo. So why don't you just do it this way? If you see a breakout and not too much volume, then buy a small amount. Enter already, but don't put your entire position. When you see that the volume is starting to confirm, then you can add later. At least yung puhunan mo, nandun na in the good price, rather than having to wait for it to escalate more. Also, if you have a breakout coming when you have that resistance step up like this, that one almost sure already. Even if the volume doesn't come immediately, that's a much nicer position to jump in rather than coming from the other side. If you have a breakout that comes from the bottom of the chart, in other words, it starts here and then it pushes all the way back up and it breaks out from then, normally I will not touch it. I will wait for the reaction after that before I buy it. Okay? The reason is because you're a lot of people making money right now. Kaba-breakout lang, kumikita na yung bumali dun sa ilalim eh. So why are you going to give them this huge amount of money-making effort now? Wait for prices to be able to make a reaction before you buy it out. So again, you don't want to be trading the extendedness of that. Okay, so here's an example of that. So you have a breakout. For example, this is Wilcon. You have prices breaking out of it. So this should be a buy point. Is the volume going up? Yes or no? Yes, okay. Then a reaction came inside. It didn't go all the way back in, but it made a reaction. If you did not buy this one, or if you didn't buy enough, this should be your next level. If you notice the correction after a breakout, look at the volume. It dries up. That means people just like you are waiting for prices to come down. They're not selling their position. They're just waiting for the price to adjust. So you should be prepared to buy in that first reaction of that breakout swing. And if you notice the swing after, nandun na naman yung volume niya. So this is a good way to be able to pick it up. Plus, it comes out pa with good news. And so if you have all these materials to be able to justify the trade, that should make a good positive entry for it. Now, let's talk about the size of a pattern. Now, the basic understanding here is the range of a price channel or a range of whatever pattern you see. If it breaks out in one direction, we'll go into that direction with the equivalent size. So for example, if you have a 6 peso and 50 stock here, the size to 8 pesos, the size is about 1 peso and 50 cents. If it goes above this particular resistance zone, this will go up by 1 peso and 50 cents in the minimum. So you can actually even target this out. So a break over 8 pesos, this will go to 9.50 minimum. That way you can get a sense of whether this is a viable trade or not, and that it can make good money for you. Just apply this to almost any pattern you make. If it breaks down, then it should go down roughly the same distance as well. So in this particular example, here you have an area pattern from 42.60 to 45.25. The size of the area pattern is 2 pesos and 65 cents. And so that means that that should go up by another 2 pesos and 65 cents, giving you a target of 47.90. So again, this is something that you can attempt to do. Again, the pattern, as it climbs up, it starts to wind up just before the resistance area. So this is a good time to be able to move into it. Okay? When you get close to your target, it's time for you to take profits. You don't have to sell everything, but at least sell half. Okay? That will be your safety net. So just in case bumalik yung presyo, at least you come out a winner no matter what. Because if you sell your second position only at the price you bought, you might be squaring there, but the other position is making money. So keep that intact. You have to take half of your profits inside when you hit your target. Or maybe if you have 90% of your target in the bag, kunin na ninyo yung pera na yan. Okay? You don't have to be too exact. I remember this person telling me, 10 centavos na lang, hindi pa niya binenta. Oh. He wanted the 10 cents down to the dot. He was more interested in the target being hit than actually him walking out making money. Right? So don't take it to that game. You can always buy your shares back after it pulls back to your support area. Remember, here you can be a scalper. You take the money, you make sure you have it. If there's a renewed opportunity that comes in later, you can always jump back into that stock later. Please, ladies and gentlemen, you be in control. Because what's going to happen here is if it almost hits your target and it goes all the way back down, believe me, I'm almost sure you're going to liquidate that at a loss. So try to get into the habit of getting money. Put it in your pocket, little by little. Keep it there. That's what a trader does. He's not here for the jackpot. And here is the sweet part, the breakout failure. You will never know whether failure is going to come. Okay, but let's teach you how to handle it. So you buy every breakout that you see. But then, if the price of your stock goes back into the pattern, that means it's time for me to be able to take remedial measures here. What should I do? So it fell back into the pattern, it rallied. What do you think? Boom. So do you wake up every morning looking like that? You can easily stop this from happening. Right? First, you have to be comfortable with the system. So what do I do to protect myself? Because this is a possibility. How do I know it's time to get out of this? Now, some people will simply say, all right, the minute that pattern goes back inside out, okay, you can do that. I will tell you this, though. Many of the stocks that go back only a partial movement back into the pattern will continue going up. So be careful about that kunyaring move to go back inside. Because some people in the market, some of these people know what you're waiting for, where your stops are, and they'll just trigger you before they start pushing it back. So this is what I'd like you to do. I want you to be able to understand this. Why don't you just cut the pattern into two? In other words, the halfway point of the pattern. And if the pullback only goes on the upper boundary of that pattern, don't sell it. If it goes beyond the middle point, get out. Or better, I like this better. Use a 20 or 50-day exponential moving average. Follow it. So if you get a breakout, for example, and you get prices going up and prices head back down, but they do not break below the 20 or 50-day moving average, do not sell. Give time for that to try to wind up and continue its breakout. There are a lot more technicians today. Some of them are really quite nasty trying to get you out. But it's very hard for them to be able to resist dragging it all the way down to that moving average. So if you see the moving average holding, then go ahead and hold on to your position. For example, look at this. This is pure gold. Right? I don't mind telling you, I was there. I was there. Right? Now I want to show you what I do as a mistake too, right? Does that look like a bullish pattern? Yes, it's an ascending triangle. That's supposed to go up. And as it's supposed to go up, there I was, scattering on. I was able to buy some, by the way, there near the resistance point, and I bought more when it actually broke out. 2 days later, I found myself in a situation. And the situation is the price starts to fall down. It breaks the moving average. That's not supposed to happen. It breaks the middle zone. It's not supposed to happen. So what do you think I did? Of course I did. Imagine I'm going to teach you how to do it, and I'm not going to explain to you what I did. I sold it. I felt really, really rotten. I said, I can't believe this guy suckered me into that pattern. By the way, it was earnings. Right? Lousy earnings. Imagine a beautiful pattern, yung pala, ang sama ng earnings niya. Here's where the technical formation did not match the potential news. And this could be surprising. Right? That fooled me. But in the end, do you think I care? Look at where it is right now. I was crying, not physically. I was crying when I sold my position here, and I said, come on, imagine I had to sell my position there. But looking at it today, and saying, oh, thank God. And look at where that thing is. And so I did not want to be making my decision down there now. So I'm super glad I was able to exit that strategy when I was there. So I will tell you, I take a lot of mistakes. Not because of a mistake that I thought was going to happen, but only because circumstance led to the mistake. It's something I cannot control. How would I know what earnings they would come out with? Right? And so handle that when it's there. Damage control. Look at this guy. Breakout. Right? Shoved all the way back up there, went all the way back down to the breakout point, and then managed to be able to climb back here. Look, the pullback went all the way back to the moving average, held on the moving average, and then started to climb again. Picture perfect. That's what you want to happen in a breakout situation. You buy on the resistance break, buy into the first pullback, you're more than making huge amount of money in a stock. That's the ideal world here. So, when you put everything all together, the basic assignment here really is to be able to line up what you're supposed to do. Size up your environment. So ask yourself, am I in a trading environment or am I in a ranged environment? That way you know which systems you're going to pull out of the hat here. 2, pinpoint your lows and the highs of the range. That way you know, okay, if I'm in a range, can I make money? Is it good enough? Where is my support? Where is my resistance? Draw your lines. 3, assess your range characteristics. Look at the shape, look at the size of the pattern, and see whether viable enough for you to trade. Does it look more bullish or does it look bearish? So just be prepared. When you say that preparation, try to be a bit more extenuating your circumstance because you know markets can either go up or go down or go sideways. You have to be mentally prepared for any one of those situations. So if it breaks out, you're ready. If it breaks down, you're ready. Emotions, check it out the door. They're just going to bother you. Measure upsides and downsides. Okay, this looks good, but after you do your little calculation, this is good or not. Right? Try to be able to do that. And try to be able to make an assessment whether this is it going to be sideways or it'll be channels that will be forming. And finally, execute the trading plan. And when it's time for trade execution, like I said, be as stoic as you can. Don't be facing too much on greed or on fright for the trade. Just execute it as close to what you planned as possible. Notice, the better the entry you have, the easier the trade will be. If you see a breakout and the price spikes and you're chasing it up here, that stock broke out nevertheless. But that's not the situation. The situation is you didn't buy it at the breakout. You bought it way up here. That's going to put you into another predicament. So dito, nag-breakout na siya. Umandar din yung barko. It went all the way back up there, yet you can't make money because you pulled the trigger very late. And so the science here, the science in trading is all entry. Selling is an art. Because selling involves emotion. All of the emotion comes into the exit. But only one emotion comes in entry. Anyone take a guess? What is the emotion you feel when you buy a stock? Greed. Very good. But when you sell, it's greed, it's fright, despair, anything you can think of, nandun lahat. Kaya nakakatakot minsan. And it's very exhilarating if you do it very well. So try to be able to just execute the plan, devoid as much as emotion as you have. All right, look at this picture. Answer my question. That, by the way, is a weekly chart. My question is, in the last 3 or 4 weeks, are you in a range or are you in a trend? Range. What's the high and low band? Roughly. 8 pesos and roughly 750, 760. Right? Okay. What is the character of the range? Is it aggressive? Are the lines aggressive, neutral, flat? rectangular, ascending triangle? What? If you notice, the line I drew on top is flat, the line in the bottom is flat. Greater chance of going up or down? Up. Very good. If prices break over 8 or 8.20, where do you think it's going to go? Okay, 9, huh? And just in case we buy it and we are wrong, where do I sell? Okay, so if it breaks the support. Now, just to let you know, I took out 4 zeros in the price of that chart. In reality, that's your index. Instead of 8, it's 8,000. All right? Instead of 750, that's 7,500. So what you just told me is that your current index is in a range. The high and low band is between 8,000 and 7,500, roughly. Range character, you said it's sideways, okay, probably rectangular. Greater chance, you just told me the index has a greater chance of going up. If prices break 8,000 or 8,200, it should go to, what did you say? 9,000. Okay, that came from you, not from me. And if you're wrong, you said to break out your support, which means you have to sell below the 7,600. You just gave me your index or market strategy, and you thought you were just buying a chart. And that's how technical analysis works, and that's how to put range trading into good use. So with that, I will hope that you would get ready into the slugfest you're about to enter, and I hope that much of the technique that we brought to you today can prove to be quite useful. So with that, ladies and gentlemen, thank you very much, and we'll get into the Q&A segment.